Hey everybody, it's Thursday, November 20th. Bloomberg put out an article where they had sort of a small version of this, what they're calling a circular financing arrangement. So I wrote some code just to pull everything I could from our Edgar database copy, and I wanted to put together sort of more detailed version. This does not include anything in the energy sector. So all of the companies that are being set up to provide power to data centers and stuff like that are not on this map. This is just what I would call the pure play AI companies. Okay. So the blue companies are publicly traded and the orange companies are private companies. So, like, for example, you've got Anthropic on here, XAI, SoftBank. SoftBank's actually publicly traded, so the code screwed that up. But Humane, here's got NVIDIA, ARM, basically every company that's involved in this, with the exception of like the micro caps. There's a bunch of really, really small bullshit stocks that aren't actually in the network, but are just kind of riding the AI narrative. But so what it's done is it's pulled out all of their actual connections. Okay, so we know like NVIDIA, these are all the terms of all the deals that they have. We know who the funding is stuff. Like PIMCO is involved in funding here. That just popped up somewhere, right? So PIMCO is actually involved in a debt deal with CoreWeave. That's what shows up. And the size of these network spans or these graph edges tells you how big the actual commitment is. Now you can go through what I'm about to do for any company that is actually borrowing money in this, but let's just do it for OpenAI because that's the easiest. So the total commitment that OpenAI has is $269 billion. Okay, that is basically to everyone who's involved here. They're going to pay that much amount out. Now it's projected that OpenAI is going to have $20 billion of revenue in 2025. Okay, assuming that the return on that $269 billion is going to be expected to be 4%, right? Let's just say that every deal, no matter how the deal structure is, it's going to basically outperform inflation. That means that OpenAI every year is going to have to pay out about $10 billion, okay? A little bit more than that, right? $10.5 billion. Now, if they're expected to have a revenue of $20 billion this year, they're paying half their revenue just for the cost of existing, basically, that, what their outbound costs are. What that means is that you would formulate out that it'll take 27 years for them to get out of that burden, which is too long. Now, another way to look at this, now, of course, I've ignored the fact that there'll be growth and everything else. I'm just giving you like the basic example of how to think of this. The other way to look at it is if they make $20 billion a year, how many people have to use their service? And this is both individuals and corporations on behalf of individuals. Like, so if you work for a bank and the bank is paying for you as part of your job to use OpenAI, how many people have to use the product and how much do they have to pay in order for OpenAI to make good on their outbound expense cost? And that is where pretty much everyone in the industry stops, because it really doesn't make any sense. There's just not enough people who are going to use these products and are willing to pay more than some trivial amount for it. Like, you can't, a person in Indonesia is not going to pay $200 a month for OpenAI. They're certainly not going to pay $200 to each of the OpenAIs that are out there, like XAI and Anthropic and all of the video services and all that kind of stuff. You're going to have very, very small groups of people who are going to be willing to pay anything at all. Remember, 98% of people who play games on their phone don't ever pay for any of it. It's the 2% of people who basically generate all the revenue. And the people who will pay for a product are likely to only pay for one. Like I personally use Claude. Um, I wouldn't pay for anything else. Like I don't have any need for any audio generation. I don't have any need for any video generation. Um, Even if I did, I would just find someone who has an account and I would just use it one time. Like I would basically have them do whatever I needed to do. Um, this is sort of the same problem that we have right now when it comes to streaming services, is that we used to have, oh, that's cool. I did not mean to do that. We used to have a situation where you would pay for cable and then you would have a couple add-ons, and that worked really, really well for 40 years. And now you have to have multiple subscriptions. And what people are finding out is that they can't justify all those subscriptions. So do you think that you personally would pay for multiple LLMs out there? It's not like YouTube where you sit down and you spend hours on it. You're not going to use these products very often at all. I mean, even if you're in the industry and you need an LLM, you're likely not going to use it outside of work. And the amount of workplaces that are going to hire these sorts of agents, they're only going to do so if they can reduce labor cost elsewhere. So there's this real bottleneck in usage here, and there's a real bottleneck in revenue. And that's what the industry sees. That's why everyone's really, really nervous. Now, there's more to it than that. What Michael Burry is talking about is that all of the extrapolations in terms of cost for specifically the data centers, and I'll get into how the data centers are actually structured in a second, but all those costs that they have associated is they believe that the GPUs and the network infrastructure and the heating and cooling systems and everything else are going to last 5 years. Well, I can tell you from personal experience here, like I know people who run data centers, that's not what's going to happen with GPUs. Like you may be able to get 4 years if you're really, really lucky, but the average lifespan of a GPU in that sort of high taxing environment is going to be 2.5 to 3 years. So these companies are estimating that they're going to need to recapitalize and upgrade all of their GPU equipment every 5 years. And in reality, they're going to have to upgrade 2.5 times during that period of time, which means that all of the money that is sloshing around in the system is only going to exist and be profitable for a very, very short period of time before you're going to need the exact same of money added to the system again. So even if you are able to scale revenue on these end companies, like the people who are actually selling the LLMs, selling the agents for video production or whatever, even if you can scale those, even if you do somehow manage to make this a product that lots and lots of people use, you're still not going to get to a revenue rate that is profitable anytime soon. And this isn't something that you expect you're going to get, in 5 years, there's going to be a GPU that's just going to be perfect and last forever. This is a continuing expense, okay? Like a lot of our infrastructure, and that's what this is attempting to build here, a lot of our infrastructure, at least in the US, has been around for decades. Once it's in place, with the exception of like small maintenance, you don't have to turn it over very often. One of the reasons why the tech bubble burst the way it did is because the infrastructure to actually build on top of didn't exist yet. That took an extra decade to work out. We had the software to run the infrastructure. We had the apps, let's call it that. We had the pets.com ready to use the infrastructure, but the infrastructure wasn't actually there yet. It took a really, really long time for that to build up. But once that infrastructure was in place, it doesn't need to be replaced very often. The AI infrastructure, these GPUs, they will need to be replaced very frequently, and the reason is because they actually degrade when they're being used at high load. Like CPUs in general last a lot longer, and motherboards and hardware and wiring and optical systems, these things are much more stable than a GPU is. Now, that may be a technology that changes, but it's not a technology that's going to change anytime soon. So how these data centers work, I I'm gonna break this down simply into a metaphor involving how production studios work. So I think most people can understand how studios work. So if you want a plot of a land and you have a building on it and you want to build a film studio, okay, like a sound stage, what you do is you go talk to a studio like Paramount and you get them to commit to make a certain number of productions in your building, right? Once you have that commitment, you then go to the bond market or you go to the debt market in general, and you can raise money to actually convert your building into an actual soundstage. And basically what you have to do is you have to have high voltage put in there, you have to have high load lines, you have to put in lights, all that other kind of stuff. Then once you've converted your building into a soundstage, then the studio that signed a deal with you, which is called an anchor tenant deal, will come in and they will make however many productions that they've guaranteed, right? So this happened here in Georgia. Pinewood Studios had I think it was a 10 or 12 picture deal with Marvel, right? So Disney agreed, we're going to pay you a certain amount of money, and they were able to get financing to basically build the studio and build it out, okay? What the infrastructure place here, what the data centers are doing is very much a similar sort of thing. They are getting financing from third parties in order to pay for or lease GPUs. And how they're doing this is they're signing contracts with the OpenAI, the xAI, the Anthropic for guaranteed revenue. And the word guarantee there has an asterisk on it. So how they're structuring this is like you agree to pay us, $10 billion. We're going to take that contract and we're going to go to the debt market. The debt market is going to give us money. That money is going to then buy GPUs with which you're going to use, okay? Buy or lease, okay? The problem here is that the people who are investing, the people who are providing that debt are the same people or are connected to the same people who are actually manufacturing the chips. So they are funding themselves, essentially, okay? And they're doing so under a contract which has exit clauses that can mean it may not be fulfilled. Like, it's kind of difficult for people who don't run companies to understand, but if you could go into a bank, let's say you get a contract from your cousin, and in the contract it says he's going to pay you $100 million for some service. If you could walk into a bank and hand that contract off and have the bank give you $2 million just on that contract, then that would be an analog to what these companies are actually doing. And some of these groups here are already really, really strapped. Like you have got the UAE Stargate Fund, you've got Saudi Arabia in here. I'm not actually sure where Saudi Arabia is, but like Magnetar is a hedge fund. You've got a bunch of investors in these they're called special purpose entities or special purpose vehicles. You've got investors who are contributing funds to these sort of circular GPU purchasing systems that are already extremely strapped. To give you a specific example, the Saudi Arabia, their sovereign wealth fund, remember, this is the same fund that a couple years ago said they were going to build a $1 trillion infrastructure project of a straight line. Okay, they have made a lot of commitments over the last few years, especially during the excitement, the euphoria post-COVID. They've committed a lot of money to a lot of projects that have not paid out, that are underwater. And those projects, if they were to attempt to sell them now, would be massive losses. So the amount of liquidity here versus the amount of commitment is really, there's really quite a disparity between the two. So when you're looking at these sort of businesses, when you look at these sort of deals, you have to look at it as like, how long is it going to take for this money to actually come in, and where is the money coming in from? And if you can't picture yourself paying $1,000 a month to all of these little AI, video, audio generation, LLMs, all that other kind of stuff, you need to seriously ask whether or not you think any of these revenue models or any of these revenue forecasts actually make any sense. And that is basically what Burry and everyone else is seeing here. A lot of this does not make sense. Now, there are, of course, options out of this. Okay, I don't want to be all doom and gloom here. Most likely, what is going to happen is agents are not going to need as much processing power. They're going to become very, very small and very, very specialized. So instead of having an agent that knows everything there is to know about your company's balance sheet or whatever, you'll have an agent that specifically knows how to deal with one section of one report. Okay. If you work at a bank and someone comes in and you need to understand something about taxes, you'll have one agent that specifically deals with just that particular question. And those agents will be much, much smaller. They will not be able to answer questions outside of their specialty domain. Now, that will lower the actual hardware cost of the system, but we are not there yet at all. And a lot of that is going to take some major re-engineering of the way that LLMs are produced. One of the other issues that you're going to have in this is that even if we do scale down the actual usage here, there's going to be a delay in power production to basically bring these things online. This is one of the issues that's going on right now. And that delay may slow down the revenue long enough that some of these companies aren't going to be able to make do on what their current commitments are. So a lot of these like bubbles here are going to get really, really, really small. And some of them are going to disappear. And fortunately, I mean, there's a lot of stuff like Spectral. There's a lot of private companies that are so small that they wouldn't even show up in here. There's literally hundreds and hundreds of AI companies right now. Luckily, a lot of those smaller players, when they basically blip out of existence, are not going to affect the graph. But the ones that are really, really big, things like OpenAI, NVIDIA, and Meta, those are the ones that are the most risk. If one of those starts to stress, what's going to happen is that they're going to have to cut back share repurchase agreements. And if they cut back share repurchase agreements, that's really the only thing keeping these companies and the US stock market as a whole buoyant. If you turn off, I forget how much NVIDIA bought back. They bought back billions of dollars last quarter. If you suddenly turn off all that buying in a quarter because you have to, there's not a whole lot of reason for these stocks to stay up. And that is something that most retail traders are not going to be able to see. You're not going to be able to see when share repurchases slow or when they stop. There's a really great quote from Margin Call. It's a movie where they talk about when the music stops, right? Well, as a retail trader, you're not going to see that. The effects of that are going to be only really noticed once the filings are happen. And if there's any sort of negative press, if there's any sort of mass selling, once that buoyancy is turned off, these stocks will plummet precipitously very, very fast. So anyways, I hope that explains basically everything that's going on here. I'd be very, very cautious, and I am being very, very cautious. We actually were way early. We exited all of our non-speculative positions last December. I actually wrote a blog post about it in December. So our largest position that we had held was QQQ calls, which we exited in December. And with the exception of some very small plays that we made in April, we never really committed money in mass back to the market, with the exception of the speculative stuff, which, in theory has other motivating factors for price changes and stuff like that. But one of the things that you should also be concerned about is that normally Wall Street doesn't advertise. Like if someone comes out and says, hey, I'm short, like when Bill Ackman came out and said, no, the economy is going to collapse and stuff like that. When Wall Street starts talking, that means they've already positioned for something and they are evangelizing their position. They are trying to do two things. They, A, want you to react, and B, they want everyone else to be nervous. Uncertainty drops bid pressure drops stocks. So when people like Burry come out and say, hey, I've got, $1 million short positions on NVIDIA, which is what he has, and $9 million short positions on Palantir, that is enough to drop bid pressure in retail. It's enough to make people nervous. And it is also enough that other people who have the same ideas are going to gain more confidence. So you're going to see more and more and more shorting. Like you won't be able to see the perspectives that are going, but there are perspectives going on right now to short these sectors. And that is not necessarily a good or a bad thing. I mean, price discovery needs shorts, but you get to a complication where there's now a battle between market makers who are profiting off the volatility and a potential change in the bias of the algorithms they run. You know, it's sort of like the inflection in the bond market that has happened recently. You had a 40-year bull bond market, and now that switched to bearish because of the way that interest rates have changed. But that there's a similar bias that goes on in algorithms that do market making. And if those algorithms were to suddenly switch and say, hey, you know what, the market's not going up anymore, the rate at which things can change could happen really quickly. So anyways, I hope I've answered all the questions. It's probably the longest video I've ever done and will ever do. Anyways, have a good day.